July marked another month of robust performance for Vietnam's economy, extending the solid growth seen in the first half of the year. The government confirmed its trade agreement framework with the United States, which includes a 20% tariff on Vietnamese exports. While most Southeast Asian countries receive similar terms, India faces a higher 25% rate. That difference could shift orders in key sectors like textiles, seafood, and electronics toward Vietnam, further strengthening its position as a preferred destination for manufacturers diversifying away from China. The broader macro environment remained healthy. International tourism continued to drive domestic spending, supported by relaxed visa rules and more direct flight connections. Retail sales benefited from this momentum, while inflation eased to 3.2%. Higher construction material and electricity costs during the summer heat were offset by lower fuel prices, helping keep overall price pressures in check. Foreign direct investment also remained robust, with disbursements reaching $13.6 billion in the first 7 months, up 8.4% year-on-year, the highest for this period in 5 years. The easing of tariff-related uncertainty has supported a strong pipeline of projects, with July seeing major investments in manufacturing, including a new semiconductor plant by US-based Coherent Corporation. Manufacturing activity strengthened notably. The S&P Global PMI climbed to 52.4 in July, up from 49.9, signaling the strongest improvement in 4 months. New orders returned to growth, while output and hiring also picked up. Vietnam is also advancing environmental reforms. The country will phase out single-use plastics by 2030 and launch a pilot carbon market for high-emission sectors such as steel, cement, and thermal power. While these measures will raise compliance costs, they are likely to benefit established players capable of adapting and attracting ESG-focused investment. The VN Index rose 8.9% in July, supported by positive developments, including the completion of provincial mergers, a new US-Vietnam trade agreement framework, and strong Q2 earnings. Trading activity hit a record high, with daily volume averaging $1.34 billion, while foreign investors also returned with net buying $326 million after major global banks like JP Morgan and Morgan Stanley also raised their outlook on Vietnam's market. Financial sector led the gains, up 11.4% thanks to robust credit growth and solid earnings. Accelerating infrastructure investment also helped real estate and material sectors to perform well, while others posted modest increase. Year to date, the VN Index is up 16.4%, mainly driven by Vingroup-related stocks and financials. Quarter 2 earnings were strong. Listed companies' net profit rose 32% year-on-year in Q2 and 25.9% in the first half of the year. Banks and real estate were the standout performers, with bank profits up 17.5% and real estate earnings surging 132% from a low base. Our portfolio gained 6.2% in July, behind the FTSE Vietnam Index's 16% rise. The gap was mainly due to our limited exposure to Vingroup-related stocks, which we remain cautious on, as their share price rally appears disconnected from fundamentals. Vingroup reported a Q2 loss of 580.9 billion Vietnamese dong, despite receiving significant one-off donation income from the chairman. While Vinhome's profit fell 30.6% year-on-year, the group's rising debt by end June adds to our concerns. Even so, we're optimistic about the broader market. Excluding Vingroup, listed companies achieved 27.7% earnings growth in the first half of the year. Sectors like consumer staples, materials, and healthcare still trade below their fundamentals, offering attractive opportunities. With a potential FTSE emerging market upgrade on the horizon and a softer USD providing support, the outlook remains strong. The VN Index is trading at 13.6 times forward earnings, and the top 100 stocks are forecast to grow EPS by 13.3% in 2025.